Okay, I have 1:02 on my clock, so why don't we get started? So, everyone, good afternoon. Happy Thursday. This is Mark Young, and we're having our weekly podcast. I'm very fortunate today to have Fred Mannix, who will be discussing the role of alternative investments. I'll just say that's code word for hedge funds. And what Fred has been able to do to make alternative investments, i.e., hedge funds, accessible to, I'll just say, non traditional investors is nothing short of extraordinary. It's very exciting what he's been able to do, what it can and should do for your portfolio is also extremely compelling and exciting. So I'm not going to steal Fred's thunder, but let's just walk through a couple of highlight slides because as per usual, these podcasts are designed to educate to the extent people think we're giving investment advice. We're not. We're giving people information that they can then take back to their own advisors and colleagues and discuss what we're presenting today and see if it's appropriate to use by those on this call. So we do have a disclaimer, and it's a standard disclaimer, but it basically says investment education is a good thing. Investment advice is something we're staying away from. So that's the full-blown disclosure and disclaimer. If anyone wants a copy of this, just let us know. There's our email at the end of this presentation, and we're happy to share any and all of the contents we're presenting today. So next slide, Jerry. So this slide, for those that have been on previous podcasts, should look very familiar. And today it's particularly relevant, and we'll talk directly to the next two slides. But basically, at a very high level, private wealth, the way we approach private wealth, I call it a three-legged stool. So you can see on the left-hand side this drawing that has a seat that's your net worth. And what is your net worth? It's your investable assets, which is what we'll be talking about very shortly. It also is your non-investable assets. Well, what does that mean? Things like your house, your car, your collectibles, your jewelry, etc. Those are all assets that in combination with your investable assets equals your net worth. Now, on top of that, your net worth needs to be protected. And depending on what your desires are, over time, you may want those assets in trust so you can gift it to your heirs or donate it to charity, or what I would call putting a wealth moat around your investments. I know in the US, Fred's calling us from Calgary. In the US, anybody can sue anybody for any reason at any time. So the more wealth you have, the more of a financial target you are. So trust and estate planning is something to be taken very seriously. And we have experts that we use to help people think and get that part of their private wealth correct. So trust estate planning is one leg of the stool. Tax planning, as I tell people, I'm a former CPA for many years ago, but I did it for 7 years. The point is, anybody can fill out a tax return, fill a tax form. That's not the expertise. That's not the skill. Having planning to minimize your tax burden, that's where the rubber meets the road. That's where you create advantages for yourself. And you're legally entitled to minimize your tax burden. So we're not doing anything that's not appropriate, but there's some tried and true efforts that we help people with to reduce their tax burden. And the beauty of this, you can document to the penny the value you're creating, because you'll know if you didn't plan it correctly what your tax bill was versus planning it correctly and the savings you generated. And then lastly, insurance is also something that has an important role in our view of private wealth. And basically, done correctly, insurance vehicles, particularly something called private placement life insurance, allows you to have a tax-deferred vehicle that allows you to put investments in that vehicle and defer all your taxes until you take the money out. So it acts like another IRA or 401k, which people are familiar with. and it gives you another way to defer taxes on your investments. So that's the first part of what I wanted to share with you. The next part, which is directly relevant to what Fred's going to talk about. So, Jerry, if you'd be kind enough to go to the next slide. Okay, you can see from this picture two things. The pie chart that shows where returns come from. The most important thing to get right, the most important, is your asset allocation. And we're going to talk about that in about 5 seconds, but other things like security selection don't move the revenue needle. Yeah, it's interesting, but it's frankly a waste of time. It's much more important to get your asset allocation right. That's where you win or lose the game. If you look on the far right, you can see 3 different portfolios. And in this example, you want to be in the top left quadrant. That's where you get the highest return with the least risk. That's the name of the game. You want as much return as possible and minimize your risks. So as an example here, a portfolio that's 100% equities has a historical return of a roughly 11%, but it has a volatility of almost 19%. So your return is less than your risk, and that's not an ideal place to be. If you look at a portfolio that's 100% fixed income, you're making a lot less money than equities, but you have a lot less risk. Compare that to this model portfolio that we advocate, which essentially has 4 components. Equities is a combination of listed equities, public equities, as well as private equities and venture capital. And that's the part of the portfolio that people like Bridgepoint help you fill in that gap. So just to keep the math simple, of your standard allocation, we're telling you to put 20% of your 40% equities in alternatives. We're also telling you to put 30% in what we call hedge funds or market neutral strategies. And that's what Fred is going to be telling us about today. So roughly 50% of your 100% investments are in alternatives with this approach. And it gives you less risk than 100% fixed income and a greater return than 100% equities. So this is definitely where you want to be, and we'll get into that in a moment. So if you'd be kind enough, Jerry, go to the next slide, please. So now I'm going to give Fred some airtime. So firstly, Fred, if you'd be kind enough to tell the audience a little bit about yourself, what you do, why you do it, and frankly, why you're here today.
Great. Thank you very much, Mark. Well, pleasure to be here with everyone. And my passion is really around capital markets, finding out who's winning, who's losing on Wall Street, and why. And so where we play at a firm I work at called Accelerate, we only provide alternative strategies to investors. And alternative strategies will be defined as anything outside of stocks and bonds. And the reason that we play there is we have 2 tools in our toolbox that most investment managers do not have access to. And that is the utilization of leverage and the utilization of shorting. We have many known strategies in the market. The ones that are most familiar will be, as Mark shared with us, you have a market neutral strategy, which effectively tries to take market risk out of the equation, and then do that by going long and short. You have strategies like arbitrage. So when there's a merger, there will often be a company that is being acquired will trade at a price that is below the actual consideration price. And over time, that discount will narrow. So that's a very common strategy that a very famous investor like Warren Buffett has utilized at time. You have strategies like long short. So you'll go 110 long, let's say, the S&P 500, and then you'll have a short book of, say, 50% the companies that you don't think are going to perform very well. And this helps to reduce risk in a portfolio, because often those strategies are even negatively correlated to the market. And that's really the holy grail of alternative strategies. When stocks and bonds are zigging, like they have been highly correlated to date, year to date, both on a downward trajectory, you have alternative strategies that are zagging and providing positive performance through their negatively correlated attributes within the portfolio. So alternatives are really a way for investors to help reduce volatility and smooth investment returns. And as we saw in a previous slide, Mark was pointing out the efficient frontier of the balance between stocks, bonds, and alternatives, where you can get the maximum amount of return for the least amount of risk. And so that's the general overview of alternatives. And I think we're going to talk specifically about how they've been implemented in the real world here.
All right. Well, thank you, Fred. Well said and nicely done of why alternatives are so important to include in a efficient portfolio. But just to take a step back, it's been many, many years that investment advisors have been advocating what I call the 60-40 portfolio for people, which is basically 60% stocks and 40% fixed income. So those are two asset classes. And the concept behind that was if your equities did poorly, your fixed income would compensate for that drawdown or loss by doing well. If you want to think of it as a pro-growth bet on stocks and a negative growth bet on fixed income, I think that's more or less the logic behind the 60-40 portfolio. Well, guess what? This year, that's been a train wreck. People who opened up their 401k statements for the second quarter saw both fixed income and equities down. And that compares to the kind of portfolio we're advocating. So just as a quick reminder, we believe that inflation sensitive and deflation sensitive is part of an efficient portfolio. Inflation sensitive securities this year, reflected in the form of the Goldman Sachs Commodity Index, which we do advocate, has been a rock star this year. Last time I checked, that index was up around 25%. And at the moment, the equity market reflected in the S&P 500 is down about 11%. It had been as poor or as negative as down 21%. And by the way, the definition of a bear market is when you have a 20% or greater decline from peak to trough. So we've been in a bear market for stocks, and they've been essentially recovering from that drawdown. But net point is alternatives and things like deflation sensitive and inflation sensitive allow you to increase return and reduce risk, which again is the whole name of the game. So Jerry, if you kind enough, would you go to the next slide?
Great. Well, on this slide, we see on the left the 5% red number. And this will be your traditional retail investor. The retail investor will be, usually a do-it-yourself professional, educated, of course, but their ability and appetite to access alternative strategies is not usually sufficient to provide that diversified portfolio. And on the right, and there's a whole bunch of reasons why for that. I mean, it takes quite a bit of time and energy to first select the right manager and then select the right strategy within that manager to complement and provide that diversification. The 52% number, that's a number that you're going to see out of pension funds, usually more than $1 billion. And the reason they have this very large allocation to alternative strategy is they have a very long time horizon, and they are highly sophisticated investors that are able to do that due diligence on strategy selection and manager selection to help complement and create that efficient portfolio. And the reason that you've really seen institutions gravitate towards this high allocation to alternative strategies is there's been leaders in the market that have a proven success record. And one of them is the Yale endowment. And I know you're familiar with that endowment, Mark. Please tell everyone how they've been doing so far year to date and through the past 12 months.
Well, let me say a couple of things about the Yale endowment. Firstly, they're a darling in the endowment world. They've consistently been a top 5 performer amongst university endowments for many, many years. So the question is, what's their secret sauce? What are they doing? And how does it relate to what we're talking about today? So firstly, as Fred pointed out, they're heavy users of alternatives. And our understanding today, keep in mind it is fluid, but our current understanding is they roughly half of their portfolio is in alternatives. So that's the first point. The second point, interestingly enough, many of the advisory board members of the Yale Endowment, coincidentally, are advisory board members of the McKinsey Investment Office, where I came from. So I'll just say they drink the same Kool-Aid, have a very similar approach to investing, and have a similar philosophy. So I think there's a lot of anecdotal evidence to say that what they're doing is very sound and attractive. So bottom line, there is an important role for alternatives. So Jerry, if you'd be kind enough to go to the next slide.
Here we are once again looking at the efficient frontier. And this is absolutely critical to understand on why you want to incorporate alternative strategies into a diversified portfolio, because we always want to be continuously moving down the risk profile while increasing return. And that is really what all investors should be seeking. And as Mark alluded to earlier in our conversation, you want to have a return profile over risk that's positive, so greater than 1. Anything less than 1 means you're taking excessive risk and generating insufficient returns. And you can see the concept of alternative strategies being implemented into a diversified portfolio there.
All right, well, thank you. Jerry, you kind of go to the next slide, please.
So this is kind of a busy slide, but we're all familiar with the XY axis here, and where we really want to concentrate is why are some of the strategies performing better than others on a return over risk adjusted basis. And these are all different strategies that you're going to see. For example, merger arbitrage, it has an annualized return that's relatively low, but you will see that the return over risk is greater than 1 there. And over the last 10 years, it has been the most consistent performer on a risk-adjusted basis of any other strategy that alternatives would be allocated towards. And this is really, you're going to work with your investment advisors or portfolio managers, and they will probably show you something very similar to this slide, because it shows where your expected return is on a risk-adjusted basis.
Let me, if I may, just make a couple comments about this chart. Firstly, this is a 10-year track record. That's a long-term track record. And secondly, some of these strategies, I'll just say, can do better in volatile stock markets like we're in today. As I mentioned, the S&P 500 had a peak to trough decline of 21%, and we're currently down around 11%. So things like market neutral strategies in volatile equity markets can do particularly well. A live example of that is Bridgewater, the largest hedge fund in the world. They're primarily market neutral, they're not totally market neutral, but bottom line, the first 2 quarters of this year, they're up 32%. 2 quarters, 32%. That's a lot. And you can see how the combination of these approaches basically have negative correlations to each other. So they minimize, in this case, the negative return of stocks by boosting returns through alternatives. And again, the combination, I believe, is what gives you the smooth ride, allows you to have steady and predictable returns in a market that's in a state of flux. Okay, go to the next slide, Jay.
Yeah, so you can see here, we were speaking about Yale, and we utilize them as really the bellwether of pension funds and endowment here at Accelerate. No point in reinventing the wheel, especially in modern finance. And so we look for clues on what they're doing, how they're positioning their portfolio, and obviously how it's performing, as we can have a lot to learn from such an esteemed institution. You'll see here the expected annualized return that they've done, and along with the return and risk profiles. And you will see there at the top is on a return to risk adjusted basis, hedge funds, which are market neutral and alternative strategies, have performed better over a long period of time. And so incorporating these strategies is proven to provide a better investor outcome.
Just to kind of build on this chart, Fred, there's so much wealth of knowledge embedded in this. So clearly, if you look at cash and fixed income, that's a pretty boring return. And if you look at what's happened in the fixed income market in the US over the last few years, and I'm using the US as a bellwether because as the US fixed income market is highly correlated to the rest of the global fixed income market. But you had a combination of fears of depression, deflation, in combination with quantitative easing by the Fed. So there's been so many things that have happened to depress interest rates to spur growth. And now that we're at full employment in the US, and bear in mind the Fed has two mandates, full employment and controlling inflation. So in that example that I gave you, you look at the return of fixed income, and on a go-forward basis, it looks pretty boring, pretty dull, because I think it's been artificially suppressed, artificially low rates, and suddenly markets are starting to normalize. Any thoughts on the fixed income market in general, Fred?
Well, I'd say, the writing's on the wall. The Federal Reserve's definitely raising interest rates 50 to 75 basis points when they come up to their meeting here September 21st. It'll be a day to circle in the calendar, no doubt. And with rising rates, you're going to see bond prices go down. So if you're holding any sort of duration of long-term bonds right now, that portfolio is definitely going down in value on September 21st. So people are looking for alternative strategies to still generate income. Hedge funds can generate income in a tax efficient manner. As we know, interest is taxed at the highest marginal rate, depending on your income. But dividends and capital appreciation are taxed in a more favorable light by the IRS, or here in Canada by the CRA. And so having hedge funds part of the portfolio can really provide a substitute to some fixed income exposure. And we're not recommending any sort of long duration exposure for anyone in the fixed income space at this moment, just simply because that rate hike is going to depress bond prices.
I think firstly, I agree with you. But secondly, the Fed's target inflation band is 0 to 2%. And the most recent inflation indicators are 8%. We're at 40-year highs on inflation, 40-year highs. And the Fed, the last two meetings, raised interest rates by 75 basis points per meeting. Now you're talking about September 21st and saying 50 or 75 basis points. Nobody knows what they're going to do. It's clearly one of those two. I would submit the likelihood of it being 75 is probably greater than 50 basis points, but time will tell. It's data dependent. But the market today, the stock market has rallied because there's a hope, there's an expectation, there's a belief that inflation will start to normalize again, come back under control. So
that's true.
So Fred,
and one point I'd make, Mark, is in fixed income, you basically are buying bonds. Let's say it's new issuance at par, and you get a coupon of say 5%. You have effectively limited your upside there, while also maintaining some safety in that the bond will be repaid at par. However, in an inflationary environment like we are today at 8% inflation, you're guaranteeing a negative real rate of return. So you're taking on risk there and tying up capital where effectively the money being repaid will be worth less than what you're investing today. So the fixed income space is extremely challenging in a low interest low interest rate environment. I mean, relatively, we still are in a, you can borrow capital very cheaply by historical terms, humankind historical terms. I know it's trending upwards, but we're in a very high inflationary environment. And so you should really be thinking about your total investment portfolio, real rate of return, and that factors in the inflationary period that you'd be in today.
All right, well said. Hey, Fred, there's a couple of questions from the audience, so I'm going to throw them at you now. Is that okay?
Let's do it. Let's bring them on.
All right. What exactly is considered a retail investor? This is from Cabo.
Yeah, so that's a good question. And a retail investor will be somebody who's managing their own portfolio. Usually it's like less than $1 million, as I was characterized it as. We see a lot of investors today are very, very good at their operating business. They're strong entrepreneurs or they're strong operators, and they focus a lot of their time and energy on growing their main business. And as that business grows and thrives, they set up a liquid portfolio of securities, and some of them manage them themselves. I would characterize those as retail. What I would characterize as institutional would be when you work with an investment advisor or a portfolio manager. You perform a know your client questionnaire, and you build a financial plan together, and you turn over discretionary capability for that investment advisor or portfolio manager to build a portfolio for you that will meet your goals on a risk-adjusted basis. I mean, there's two things when you're working with your portfolio manager that are critical for them to understand. What is your tolerance of risk, and what is your ability to bear risk? And together, those two have to sync up. And sometimes retail investors, to their own detriment, their ability to bear risk and their willingness to bear risk is not aligned.
Okay. Fred, another question from the audience, this one from Jerry Chu. His question is, how's the investment environment in Canada right now?
Jerry, that's also a very good question. Well, as your northerly neighbors, we are very dependent on resources. And, as we heard here from Mark, the Goldman Sachs Commodity Index is doing very well year to date, up 23%. So that'll include, resources like gold and oil, natural gas. And Canada is a big producer of natural resources. So our economy is performing extremely well on the resource front. Where I'm from here in Alberta, we export about 3 million barrels of energy a day. And we all know that energy prices are up significantly since last year. So Canada is really in a good spot right now. Our currency is also weaker than the US dollar. So we have a competitive advantage as a manufacturing base, and we're able to manufacture each unit of goods in Canadian dollars. So our input costs are a little bit less. And then often we export them to the United States, which then are transacted in US dollars. And a good example of that would be, West Texas Intermediate. We have all our operating costs in Canadian dollars expenses, and then we sell the final product in US dollars. So that's a pretty good example of how in Canada we have some advantages around resources. There's other things that America does much, much better than Canada, and we won't go into those, but one of them would be definitely the efficiencies of the capital markets. Just if you're not aware, Canada only has 6 tier 1 banks, so they can offer all the services that you would expect that, your Bank of America or Wells Fargo. And so that really reduces competition. And one of the things that Canadian banks do, if you're an investor in their shares, is they have the highest return on invested capital anywhere in the developed world, simply because they're protected through regulations. So some good things in Canada, some not so good things. But I'm a big fan of the American markets and the capitalist nature of your country.
Well, I'm talking my own book here when I say this, but I do think America and its ability to innovate, particularly when it comes to healthcare, which is a sector that Bridgepoint is highly concentrated and focused on, definitely is, I'll just say, globally an advantage that the U.S. has today. However, I do think a lot of the policies that the Canadian government has deployed in places like Toronto and other areas have made it very attractive for entrepreneurs to create their businesses in Canada today.
Absolutely. And entrepreneurs are going to look for places where capital is welcome and where tax regimes are welcoming to new capital. I mean, as we know, we live in a global financial system here today, and capital is mobile. It's going to go to where it's most welcome and most tax efficiently treated.
Well said. I have another question, Fred, from the audience. So you ready for this one?
Let's bring it on.
Okay, this is from Robert LeBoyer. He says, we have had low unemployment with high inflation, declining retail sector, and declining GNP. What kind of investment strategy would you recommend?
Well, Robert, that's a complex question, as really it depends on what your time horizon is, what your risk profile is, and your ability to bear risk. Now, saying all those things, I think if we're talking about the current situation, where am I deploying capital today? I'm deploying it into the equity markets, and I'm deploying it into the equity markets because what I think is happening right now, and so equity markets would be, your traditional private equity, public securities, or maybe even some hedge fund strategies, which we, obviously specialize in here at Accelerate. What I'm doing with capital today is I'm putting it into companies like pipeline companies. And if you were familiar with Kinder Morgan, for example, their counterparties are, investment grade energy and producers in the United States, and they come with 20-year take or pay inflation protected contracts. So they have a very stable cash flow base, and that's where I'm deploying capital today. They pay a great dividend, so they're able to distribute some of their earnings in a tax efficient manner to investors. And they have Rich Kinder as their chairman, who owns a significant amount of the stock. Has been able to grow a very sizable network of oil and gas transportation through the United States. And, that's just one area where I'd be deploying capital today. I also think, like a company like JP Morgan, run by another strong leader, Jamie Dimon. I'm a big fan of his. And I'm a big fan of his because he's a great operator and he understands the complexities of the financial markets. And he has a major tailwind in his back in that net interest income in a rising interest rate environment is only going to increase. And that's about half of the revenue that JP Morgan makes each quarter is generated through net interest income. And that's when you have deposits at the bank. Let's say you have $100 in the bank. They might pay you 3 cents a year on that deposit, but they'll go lend it out 3 or 4 times and they'll charge 5%. And so they generate a great rate of return off your deposit. And in a rising rate environment, they can charge a higher interest rate to their customers while effectively still paying you only like 3 cents a year. So that's going to be, financials are going to do extremely well as long as their loan books don't take impairments. That'll be another key thing to watch in the U.S. financial sector, that the major banks are not taking impairments on their loan books.
So I know, Fred, this audience definitely cares a lot about current yield, current income. You mentioned the Kinder Morgan example, and clearly it's a very stable cash flow, but I don't know what they're yielding today. Do you have any idea, for the audience's benefit, what they could expect on an investment like that?
Well, you're going to get a dividend income of around, I believe it's around 5.5% today. And, the shares are trading, at a reasonable multiple today. I can't remember exactly off my head, but pipeline companies are very stable cash flowing entities. They're not going to, shoot the lights out, but generally, people that I hope are listening here today are in the capital preservation mindset and, happy with the single base hits up the fairway. I mean, we'd all like to, have that 20 bagger in the portfolio, but, those are tough and unique to come by. And, we've seen those great investors over time, like a fan of mine is Warren Buffett. He's, the slow and steady, and he looks for companies that have competitive advantages in the marketplace and applies capital to them. And I think, a company like Kinder Morgan or JP Morgan, they both pay a dividend. They're very strong leaders. They have dominant positions in the marketplace. And over time, those management teams are going to grow earnings. And with a growing earnings stream, the stock price will eventually follow.
Yep. I'll just say investment 101. It always starts with betting on this strong management and their competitive position in the market, and whether they have headwinds or tailwinds in their business. And as you pointed out, in the banking industry, you're spot on. The gross margin or the profit they make for their business, which is really, in theory, the lending business. So their cost of their deposits does not move as rapidly as they can loan the money out. So that margin expands, and that's money that goes right to the bottom line. And that's the environment they're in today. But you rightly point out that works as long as the loans get paid back. And if they do foolish things and overextend their loan book, or they have bad debts, et cetera, that dynamic, your asset becomes a headache or a liability. So time will tell if they've been disciplined in their underwriting or not. But all indications are that they have been.
Yep, I would totally agree with those comments. And if there's only a few things to watch in the economy as the days unfold, I would say really understanding credit loss provisions at the major banks and loan loss impairments and provisions at the major banks. That'll tell you the health of the consumer. And as we know, the consumer, the American economy is about 70% service based. So if there's problems there, we will see other problems reverberate through the economy. So those will be early indicators to watch.
All right. We have another question, Fred. This one related to Jamie Dimon, your hero. Christine Chen's comment: Jamie Dimon recently gave some ominous warnings, including 20 to 30% of something worse, in quotes, than a recession due to Fed rates, oil volatility, quantitative easing, etc. Do you agree with that, his assessment?
So Christine, good question again. And I can tell we have a highly engaged audience, which is a lot of fun. Jamie Dimon is CEO of a major financial institution. And so sometimes I feel like what we hear and what is the truth are maybe not 100% all aligned. And I say that he was very disappointed with the SEC on the latest earnings call because they reduced his ability to buy back shares. And his comments were that there was an impossibility that they would suffer a $44 billion write-down during a severe recession. But the financial modeling experts at the SEC disagreed and basically put the brakes on his buyback. So in one way, he has some posturing that he's performing with the investment community, posturing with the SEC, and his comments around 20 to 30% something worse than a recession. Well, we all know that is a possibility. I don't think it's quite that high, but no one saw COVID coming either. No one saw the financial crisis coming either, except for very, very few investors. But black swan events do appear, and I think some of his comments, particularly what you mentioned there around the Fed tightening, for him, we all want a soft landing in a rising rate environment, because a recession is a negative feedback loop, and to jumpstart the economy, you have to effectively make the cost of capital go down so that people start investing and borrowing again. And so he's providing commentary to the market that we don't want a negative feedback loop. So the Fed better watch out that they don't raise interest so much that they plunge us into a recession, because we've all felt it in our pocketbook. If you have a line of credit, interest payments have gone up. If you just refinanced your house, interest payments have gone up. And what have you done with that increased cost to your expenses? Well, you've spent less or you've invested less. And that effectively cools the economy. Now, What we don't want to do is you just completely stop going out or completely stop, having fun on the weekends. And that will severely reduce the economic activity within the economy, which is what nobody wants. So it's a fine line between raising rates and cooling the economy, and raising rates too much and crashing the economy. And so I think he's speaking a little bit with those comments to market observers and telling them, watch out, because this is a dangerous game we're playing here.
Let me just build on what you said, Fred. And I do agree with what you said. Firstly, I call it the Goldilocks approach by the Fed, where the porridge is not too hot, not too cold, just right. So the job or the objective of the Fed is this proverbial soft landing, meaning slow the economy down through rate increases, but not so much that they push the economy into recession. The sad track record of the Fed is most of the time they go in a tightening cycle, they overdo it, and we go to recession. So the jury is out whether they'll get it right this time or not. But I'll just share with the audience, the medicine of a rate hike takes up to 6 months to percolate through the economy. So the rate hikes they're doing now, we haven't seen the effects of yet. And that's part of the reason that their tightening cycles lead to recessions, because they're looking in the rearview mirror as opposed to looking forward. So it's a very challenging thing to get right. And also, the U.S. economy is 2/3 the consumer. And the consumer can go from hot to cold. So at the moment, with a full employment economy, there's still spending, although we've seen some evidence in retail that they are pulling back a little bit. You've seen a lot of evidence in the housing market that there's been a dramatic pullback there. So you're seeing signs that the Fed's rate hikes are doing the desired effect. But will they get it right? Remember, their target is 0 to 2% inflation, and we're sitting at 8. So that's a wide gap. And my own personal opinion is the market is underestimating how much the Fed will have to tighten to get back in its target inflation range. But we'll see. No one can say for sure. So, Fred, I have another question for you. It says, can you share a little bit about your fund, including where we can get it and the management fees? So I don't know what you wanted to share with us, but you can treat this as an advertisement. You can talk about your fund and your firm.
Right on. Well, I appreciate that. And we can, if you're curious to know more, you can grab my email through Mark after the podcast. But I oversee a strategy, a hedge fund called Standard Wealth. And right now, we're utilizing some leverage, prudent leverage, and it's a bottom-up value investing strategy. So it's, comprised of companies like I mentioned, Kinder Morgan, JP Morgan, the Canadian banks. It has a 4.5% dividend yield. There's no management fee. And I have most of my liquid net worth tied up in this strategy. We only charge a performance fee, so you have alignment between the manager and investors. And I'm happy to talk about that all day. And on the ETFs, which we are exchange traded funds here in Canada, we have strategies like long short, arbitrage. We have a fund of funds. We have a Bitcoin ETF where we track the price of Bitcoin. It's passive in nature, but we're the lowest cost provider. And we're also the first carbon negative fund in the world. We take a portion of our management fee and we plant trees with it. And last year we planted about 15,000 trees. So doing real world good, we think the intersection between cryptocurrency, Bitcoin, and the ESG movement will be powerful. And, you can access these strategies as long as, the market's open. Toronto Stock Exchange is open the same days as the New York Stock Exchange. And I'd be happy to send you some material on any of those strategies if you'd like to know more.
All right, Fred, you dance a thin line between education and giving advice. So I applaud you for not tipping over that line, but thank you. And I thought that was a terrific answer. Jerry, if you'd be kind enough to go to the next slide, please.
Okay, so the 3 key takeaways from today. I think, we've had a really good discussion here today. I thank everyone for joining. Hopefully, we're able to show the efficient frontier and how incorporating alternative strategies can help you on a risk-adjusted basis actually improve performance and reduce volatility. And the way to access these strategies has been becoming more and more easy over time. 20 years ago, you needed to be an accredited investor. Today, you can access these through, closed-end funds, mutual funds, exchange-traded funds, and these are much more investor-friendly vehicles to access them. And the third and last thing I would say is that alternative strategies, they reduce that volatility. That volatility in your portfolio. What do we see out of most retail investors is they sell at the worst time, they sell at the bottom, and they buy at the top. And these alternative strategies will help you augment your portfolio so that at the bottom, if you wanted to actually time it right and do it the opposite of a general retail investor, you would have some dry capital available through your alternative strategies because they're negatively correlated, or at least no correlation to the equity markets. You could sell those and then buy the names that are now on sale that are down, like we saw there in June, with the S&P down 20%. Well, everyone would love to buy, Google down 20%, or JP Morgan, or whatever the company is that you've decided that you want to allocate towards, and you can do that with capital that's being provided through alternative strategies. So I think the main takeaways here are, if you can work with your advisor on talking about alternative strategies, I'm sure you're going to have a great discussion, because we're going to see more and more allocations to these type of strategies as we continue down the investment road.
Well, I would 100% applaud everything you just said. I guess on top of that, bring it back to where we started. Your asset allocation, getting that right is so critical. And the kind of strategies Fred's talking about, one of the many things that's exciting about it is you don't really have the lockups you have in some other vehicles. So if you're just looking to put your money to work, we know that if you put your money in a bank account, you're getting negative return, because inflation is 8%. If you can get 2%, you're lucky. So you're losing 6% a year real return at the moment, which is kind of silly, versus the kind of strategies we're emphasizing and Fred's talking about. You can put that money to work, and when the time is right and you're more confident or ready, you can basically sell that and buy something else or keep it there. But flexibility is really an undervalued feature when you invest, because things do go on sale. The irony is, as retail investors, they love it when it's at the highs and they hate it at the lows. But that's the exact opposite of what prudent investors can and should be doing. So you really need to be disciplined, get your asset allocation right, and tactically rebalance. When things go down, that's not a time to walk away. That's a time to double down, or take your winners and buy some of your losers, so that over time you're dollar cost averaging and you're getting the smooth ride that we're all seeking here. So I have one, I guess it's really more of a question/comment. This is from Joan Perry. Is this podcast recorded? The answer is yes. And it was just posted in the comments. So anybody that wants to listen to this at their leisure or share it with their friends, we're here to get what we believe is important information into the market. So we encourage you to share this with others. And I just, in summary, really wanted to thank Fred for not only a lively discussion, but a powerful and informative discussion. And I hope, Fred, that this will be the first of many podcasts we do with you, because we're just scratching the surface to what you're doing, and it's really exciting. And here's this last slide. This is our emails. If you want to get a hold of Fred, just email me and we'll get you his contact information straight away. But again, thank you everyone for attending, and Fred, thank you for a lively discussion. I really appreciate it.
It's been a lot of fun. Thank you very much for having me, Mark.
My pleasure.